Hi everyone, I'm Ching. Today I'm going to share with you how I'm going to plan for retirement. So this will be my retirement calculator that I'm sharing, and I'm going to let everyone take a look at how I'm going to do it. Okay, so for example, let's say I'm 49 years old, even though I'm not. Alright, I have an initial capital of $70,000. Alright, so I'm going to assume that my average growth rate for the long term, alright, if you're investing, you need to invest for a long term, because some years you will get a good growth rate. Maybe you can grow like 20%, maybe 30% in very bullish years. Some years are just average like 5%, 10%. But some years will be in a correction market, maybe negative 10%. Some years we are in a bear market, maybe negative 30%, negative 40%. But most years are most likely going to be a bull market. So the S&P 500 growth rate is usually in between 6 to 10%, right? Or rather 6 to 8%. That is the average growth rate. So some years will be higher, some years will be lower, some years are negative. But most years are still in a bull market. Alright? So I'm going to assume that growth rate is 10%. And I'm also going to assume that, as an investor, if you can't save money to invest, then I would rather you don't invest. So I'm going to assume that you can save $10,000 a year, which makes it about $833 every month. Alright? So let's say $1,000 a month. Try to save $1,000 a month at least. Alright, so you can save and invest in the portfolio so that compounding can work. So if you see how this compounding works is, if you have a growth rate at 10%, your starting capital is at $70,000, and you have a $10,000 saving. So you add in money every beginning of the year, you let it compound, and at 64 years old or 65 years old, most likely you would have, not most likely, most probably you would have a $671,000. And let's say you have paid off all your debts, you are debt free, and you can withdraw $50,000 every beginning of the year or every end of the year for retirement. And that makes it about $4,000 a month for you to spend. Alright, I think that is quite reasonable for most people. For the own individual to spend $4,000 a month, you should have enough for holidays. Alright, you will also not deplete your portfolio, because why? Your growth rate is higher than your withdrawal rate of $50,000. So even though you were to retire at 65 years old, you withdraw $4,000 every month. Alright, you use $4,000 as your expense up to 78 years old. As you continue to compound, alright, consistently at 10%, some years higher, some years lower, your portfolio will still compound until $1 million. So by 78, you will still be a millionaire on a very conservative basis, because you continue to save and invest $1,000 every month. Alright? And at 79 years old, as you can see, I've reduced the growth rate to 5%. So maybe at 70 or 80 years old, you are no longer very active in investments, your mind can be a bit slower and all that. You decided to let your bank managers run it, or you decided to go for a lower growth rate. You can be buying corporate bonds and all that offers you a growth rate of maybe 5%. Alright, but every month you still withdraw $50,000, which is $4,000 a month. You can still able to maintain your lifestyle until 100 years old. Alright, and you can still pass on the portfolio that you have, which is close to $1 million, to your dependents. So this is my plan for retirement, very, very conservatively. Alright, and that is at age 49. Of course, if you are younger, you have more time to compound. Alright, when you retire, you will definitely have more money at the end of at your retirement age. Alright, at 65 years old. So let's say if you are not able to grow your portfolio at 10%, maybe lesser. Alright, so if I were to change it to 8% a year in terms of growth rate, alright, as you can see, you will not be able to withdraw $50,000 every year, because you would actually deplete your portfolio because the growth rate is slower. Can you see that 2% of growth rate makes a lot of difference over here? Okay, so that means your withdrawal rate has to be lower. Alright, it's either you reduce the amount that you withdraw, or you increase your growth rate. Alright, okay, for those, I'm not including dividends. So dividends to me is a bonus. All right. So this is only a withdrawal rate from your portfolio value. All right. So any dividends that I receive is a bonus. And of course, with dividends, you can always reinvest it back into your portfolio again. All right. But for me, 8% is a bit slow. That is really average S&P 500 returns, 6 to 8%. All right. Some years, maybe 10%. What I'm achieving is currently is about 20%, but I'll be very conservative. Let's put at maybe 15%. Right. So if you look at 15%, of course your growth rate will be a lot higher because you're compounding at 15% every year. Some years higher, some years lower. All right. But investing is the long-term game. All right. So of course at 63 years old, you have hit $1 million, and if you continue to withdraw at 50,000 a year, your portfolio will continue to compound a lot more. So by 78 years old, you will most likely have $6 million. All right. Of course, because you are compounding a lot faster, you are able to withdraw more money. All right. But if you can't grow at this rate, then let's stick to 10%. Right. If you're investing on your own, 10% should be a reasonable target for you to achieve in terms of your portfolio returns. All right. But of course, if I were to change it to like 6%, okay, very super conservatively at 6%, your withdrawal rate need to be lower. All right. Your withdrawal rate cannot be at $4,000 a month. Right. Let's say $25,000. All right. So let's take a look at this. Okay. Can you see that the 2% in terms of the growth rate actually it makes a lot of difference in terms of your withdrawal rate, all right, as you compound. All right. I think this you can only do $20,000 a year. All right. So I just want to make sure that after withdrawing money, you're still able to grow the portfolio. So $20,000, if you were to divide by 12, how much would it be? That would be about $1,600 a month. So that is like, the minimum requirement in Singapore for you to retire according to the government statistics. All right, that is about 1,001, right? Very basic minimum, 1,006, all right, a month in terms of $20,000 withdrawal rate. So if you look at this, right, if your growth rate is slower, 6%, you can only withdraw $20,000. Of course, if you are at 49 years old and if you have a larger capital, you can save a lot more money. You're able to compound your portfolio even more. Okay, in conclusion, having a high growth rate portfolio is important to retire comfortably and also to build and accumulate wealth. Okay, that's all for today, and this is how I plan for my retirement, and I hope this is helpful for everyone. And if you like this video, please like and subscribe our channel.